This is the Daily Market Comment by Marios Hadjikyriacos. I'm Maria Pashurdiz. Thanks for joining us at XM.com. There has been a tectonic shift in global markets this month, with concerns around an impending recession overshadowing inflation as the main threat to the outlook. This was reaffirmed by the latest business surveys from Europe and America, which were an absolute horror show, signaling that both economies are already in contraction as demand has started to lose power. The world economy is slowing down at a dramatic rate now that the fiscal and monetary stimulus is rolling off, while the cost of living crisis bites consumers, sending traders scrambling to recalibrate the trajectory of the federal funds rate lower. Bond markets are still confident the Fed will deliver a triple-barreled rate increase this week, but the terminal rate has been revised down to 3.40%, and rate cuts are expected to begin early next year. The prospect of a downturn that cuts short the tightening cycle of central banks around the world came as music to the ears of the Japanese yen, which has been devastated by the Bank of Japan's refusal to consider tighter policy. Aside from the yen, the reaction in the broader FX complex was not so straightforward. Most major pairs had a volatile session but closed almost unchanged. The euro went for a ride, losing ground initially after the dismal European PMI readings, although it managed to recover later on as the equally grim US numbers knocked the wind out of the dollar. It's a huge week ahead for the dollar, with a Fed rate decision on Wednesday and the latest GDP report on Thursday that will reveal whether America is in a technical recession already. In the commodity sphere, gold bounced back too. Bullion found fresh buy orders last week and came back with a vengeance as growth worries torpedoed bond yields and the dollar finally lost some steam. With markets transitioning to a paradigm where recession is public enemy number one and inflation loses its punch, gold might manage to stabilize, although any trend reversal will likely have to wait until the Fed hits the pause button. Alarming business surveys and a disastrous earnings report from Snapchat sent shivers through the entire equity market on Friday, hitting ad-focused businesses like Google and Meta particularly hard. Even though Snap is much smaller and caters to an entirely different demographic, traders are cutting positions first and asking questions later, worried this might be the canary in the mine for the cyclical advertising sector. This is today's Daily Market Comment. Thanks for joining us at XM.com.